Hello, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. With this Analyze Out Loud video, I'm going to take a deep look at Procter Gamble utilizing several different valuation metrics. Now, before I get looking at valuation from several different metrics, I always like to start out by just looking at what kind of business I'm investing in or I'm researching by looking at earnings. So what I've got here now is a fast graph with Procter Gamble's adjusted, or what we like to call operating earnings, going back to their fiscal year ending June 1998. So, we got roughly 20 years here, including some estimate data. Now, what's interesting about this, as I hope you all can see, what strikes me most is you can see that from the beginning of 1998, actually through the Great Recession, through June of 2009, Procter & Gamble was generating some pretty strong growth. So let's go back and let's scroll back here, and you can see that their adjusted operating earnings growth was very consistent at about 10% per annum. But what's also interesting, and what you should have noticed, is when you look at it going forward, their operating growth since 2010 has been actually very slow. So I'm going to cut out the estimate data here and just look at operating results. So since the beginning of fiscal year 2010 to the end of fiscal year 2017, again, which ends in June, the company actually had a negative -1% growth rate. So when I open this up again and look at it from the perspective that I initially showed you, you can see very nice growth and then flattening of growth. But then if you look at the forecast data, which I talked about in the written portion, analysts are expecting this company to have a resurgence of growth. Now, there's a lot of things going on with Procter & Gamble. They're investor activists wanting to, change, just been elected to the board. They want to change the way the company's structured. The company has cut out, as I mentioned, 100 items and cut it down to 65. So the company's doing a lot of things to reinvigorate growth. And the analysts expect that growth to go ahead. But the key here is I wanted you to see that you're looking at a company that had very consistent growth and then very poor growth for a period of time, and now it's expected to resurge again. Now, next, I want to bring in dividends and the dividend payout ratio. In contrast to what we see with earnings, the company's dividend record has been stellar. As suggested in the written portion, they've increased their dividend for 62 consecutive years. You can see that that growth has been very consistent. If I get down here to the long-term performance result, since June of 1999, you see that their dividend has grown by an average rate of 9.3% and a compounded average growth rate of 9.2%. But I also want you to notice that their dividend growth rate has slowed down during that period where their earnings growth slowed down. So the company has been evolving and changing, and that's very important. Now, I'll go ahead and stack the dividends on top, the dividends as they've been paid out. The area below this white line is the dividend payout ratio. So what I'd like to next bring in is stock price. And this orange line would be a theoretical valuation reference of intrinsic value or fair value. But when I bring Procter & Gamble's monthly closing stock price, you can see that the company's price rarely ever touched that orange line. In fact, it wasn't until the Great Recession where it actually got below the orange line, which is, by the way, a PE of 15. So now I'm going to bring the normal valuation over this long time frame. And what you clearly see is the market has historically valued this stock going back to 1999 at about 20.6 times earnings. You can see the blue line is a PE of 20.6, just so you're clear. So you see PEs of that or higher all these years. Of course, we had the irrational exuberance period where valuations got excessively high. And then valuations got pretty high in 2016 and 17, but now we've had a nice correction somewhere in a neighborhood of 17 to 20%, which now brings it below its historical normal PE ratio. Now, if I shorten this graph down to 10 years where the growth rate was very low, what I want you to see is that the company still commanded an 18.5 normal PE over this time frame. As we came out of the recession, it kind of reverted back to a higher valuation. If I shorten the time frame again to where we're looking from 2014 forward, we can see that we're back to that 20 normal PE, and right now the stock price is below that. So based on adjusted operating earnings, the company looks undervalued based on historical precedent at this point in time. Now let's move on to GAAP earnings and take a look at GAAP, because there's some very interesting aspects of what GAAP actually reveals about Procter & Gamble. First of all, and this is something that I think is very important, we see that there was a lot more volatility with GAAP earnings than we saw with the adjusted operating earnings, especially in fiscal year 2015, again, ending in June of 2015. But I want you to notice there was some market price reaction to that, but the valuation still stayed very high. Now we've got a normal PE for GAAP earnings of about 22.4. So the market likes to value this company high. Now it's AA rated, only has 20% debt, and I think that's part of the reason why this company is given the high valuation. So next, let's look at valuation through the eyes of operating cash flow, because I think we also get a different aspect or different picture of valuation when we look at operating cash flow. First and foremost, we see a much higher correlation between price and operating cash flow over this period of time. Similarly, we see the irrational exuberant period where price to operating cash flow got up to 27.7 in November before reverting back to this normal 14.8 to 15 PE. Notice the orange and blue line on this time frame are virtually superimposed. So the blue line is a PE of 14.8, the orange line is a PE of 15. So we saw some reasonably high valuation in 2017, and then that's reverted to the mean, and now the company looks like it's trading at its normal price to operating cash flow. Now there's another reason I like to look at price to operating cash flow, because I'm also looking at dividend coverage. As you can see here by looking at this graph, the company's operating cash flow clearly covers the company's dividend. They're throwing off about $6.8 billion in dividends and a pretty close to a similar number in share buybacks, which I'll talk about later. Now, let's look at free cash flow, but when I look at free cash flow, I like to take price off because I'm not interested in valuing the business based on free cash flow. What I'm really looking at is dividend coverage when I look at free cash flow. Free cash flow is what's left over to pay dividends after the company has spent the money it needed to run its business. Now, we had a pretty high payout ratio in fiscal year 2000. You can see that the dividend payout ratio got over 100% of free cash flow during that period. But otherwise, Procter & Gamble has been consistently paying out about 30 to 40% back in the growth era, and now in the more recent area where growth has flatlined, it's paying out 65 to 77% at the high. But they still have ample free cash flow to cover their dividend. Now let's look at another valuation metric. Let's look at price to EBITDA, and I'm going to go ahead and put price back on the graph. And now I'm going to look at EBITDA, or earnings before interest, taxes, depreciation, and amortization. And once again, you see that we've had a normal price to EBITDA of about 11.3. That's precisely what Procter & Gamble is currently trading at. So based on that historical precedence, the company is fairly valued and offers this 3.7% dividend yield. And speaking of the dividend yield, it's another valuation reference that I always check, and I mentioned it in the article. If I bring the dividend yield up here, you can see that even when the price got very low, where the price to EBITDA was down to below 8, we only had a dividend yield of 3.2%, 3.5. At the end of last fiscal year, it was 3.6. And we're currently at 3.7. So as I stated in the article, this is one of the highest dividend yields the company's had. Now, when it got real cheap down here in April, at the end of April, it was yielding 3.8 or 9% at a short period of time. But this is a very high dividend yield, implying that the company is undervalued. Now, a couple other earnings metrics I think are worth looking at would be looking at price to sales. And you can see the company on a price to sales basis is trading at about 3 times sales. And that's above normal or slightly high relative to its historical norm. But part of that is because sales have actually been dropping in recent years. And I'll talk more about that here in a moment. Nevertheless, the bottom line here is that Procter & Gamble is currently fairly valued based on most metrics that you would utilize to value business. Price to EBITDA, price to operating cash flow, and of course even price to earnings based on a historically high normal PE multiple. The company looks reasonably valued based on how the market has traditionally valued the stock. So let's look a little deeper under the hood here for a moment. Let's go into financial underlying numbers, or fund graphs. The first thing I want to look at are revenues per share, and you can see revenues per share have been in a downtrend through fiscal year 2016, again ending in June. Let me shorten this time frame so all the years are listed here. But then we've got a little bit of a recovery by June of 2007. Next, I'd like to take a look at some balance sheet items. Let's look at cash and cash equivalents per share. And you can see that they have about $2.14 a share through June of last year, approximately a year ago, of cash. That was down from $2.63 the previous year. And the high was $3.15 a share in 2014. But the company does have ample amount of cash on their balance sheet. When you relate that to debt, both debt long-term and short-term, A significant portion of their debt is long-term debt, which is the dark blue line here. But other than that, the company does have a little more debt than that. But keep in mind, their debt to capital is only 20%. So this is really not a debt burden or debt-laden company. And for those who like book value, their common equity or book value per share has remained reasonably stable going back to 2005, and it's actually starting to, moderately perhaps improve a little bit going forward. Next, I'd like to look at the percentage graph and look at gross and net profit margins. You can see their gross margins hover around the 50% area, and they're pretty stable there. Their net margins are in the teens. Their net margin did increase quite a bit in June of 2017. However, more recently, for the quarter in March of 2018, it flattened a little bit, but it's starting to improve. These are the last 12 quarters for the company. They did have a really high gross margin in December of 2016. But the main takeaway here is their net margin stays in that 16 to 17, maybe 15 to 17% range, and they're continuing to do that. Next, I'd like to look a little deeper at share buybacks. The company has been modestly reducing their share count. They went from 3.18 billion in June of 06 down to 2.55 billion shares outstanding by June of last year. But most of these purchases have been when the company's valuation was low. When the valuation was high in 05, 06, and 07, they were actually issuing shares. And I kind of consider that a good thing. I don't like to see share buybacks when valuation is high. However, valuation has been reasonable during this time where the company's been buying back their shares. Now finally, I'd like to conclude this video by doing some forecasting here. And as I mentioned in the written part, I'm trying to ascertain a reasonable expectation of what kind of money you might make in Procter Gamble. Now, when I look at operating earnings and a normal operating metric of 15 times earnings, the stock looks overvalued. But once again, if I go to the normal price earnings ratio, this is the 5-year normal PE, I can use this pop-up here and you can see this stock has, comfortably traded between, we'll say, mid-18 or even 18 to 20 times earnings has been normal. So I'm actually going to pick the lowest here. I'm going to pick 18.1 as a normal multiple for this company, and then go out here a year or two, and I want you to see that based on that multiple, this company has an opportunity to generate about an 8.8 to 9% rate of return. And then if earnings accelerate a little bit in 2021, and there are 3 analysts who think it's going to be a good year for what that's worth, then we could see it going into double-digit returns. If we used a more normal 20 PE ratio that I talked about quite a bit in the beginning of this presentation, then it could generate 19 to 20% rates of return over the next year, and going out all the way to 2021, it could still be double-digit 14% rates of return. I think this is all doable. Now, the long-term trend line forecast, only based by 4 analysts reporting to S&P Capital IQ, expect them to resurge their growth back to 7.2 or 3%. So if I measure that using these 19 to 20, I'll use the 19.5 PE ratio here. This could generate 11.5% a year rates of return, including dividend income, over the next 4 or 5 years if the company was able to resurge its growth. So bottom line is, the real question I think all of you need to ask is the company going to go back into the growth phase or something close to what it did historically? Is it going to get back to a 6 or 7% growth and overcome that low growth that it had? Well, there's a lot going on in the company that I think are leading some of these analysts to believe it can. The company certainly has a lot of financial flexibility. It's a great stock. It's been around forever. It's an iconic brand. It's very powerful in all of its categories. It's AA- rated, offers a 3.7% dividend yield, and therefore it might be one that's actually worth a look, especially for those of you who are looking for safety and a good current yield on their investment. This has been Chuck Carnevale saying thanks for watching.